Derivatives. Derivatives in CFA Level 1 introduces financial contracts whose values are derived from underlying assets such as equities, bonds, interest rates, commodities, or currencies. The curriculum explains the basic characteristics of derivatives and the structure of derivative markets, including exchange-traded and over-the-counter markets. Candidates study how derivatives facilitate risk transfer, price discovery, hedging, speculation, and portfolio management. Understanding derivative instruments is important because they are widely used by corporations, financial institutions, and investors to manage market exposures and improve investment efficiency. The curriculum emphasizes both the benefits and risks associated with derivative usage, including leverage, counterparty risk, and market volatility. Derivatives provide investment professionals with flexible tools for managing financial risk and implementing strategic investment decisions across global markets. The curriculum examines the major categories of derivative instruments, including forward contracts, futures contracts, swaps, options, and credit derivatives. Candidates learn the contractual features, payoff structures, and economic purposes of each derivative type. The curriculum explains the differences between forward commitments and contingent claims, helping candidates understand how obligations and risk exposures vary among contracts. Candidates also study how to determine option values and profits for long and short positions in call and put options at expiration. Understanding derivative payoff profiles is essential for evaluating hedging strategies and speculative opportunities. These concepts help investment professionals analyze how derivative positions respond to changes in underlying asset prices, interest rates, and market conditions within different investment and risk management strategies. A major focus of derivatives is the role of arbitrage, replication, and cost of carry in pricing financial contracts. Candidates learn how no arbitrage principles ensure consistency between spot prices, forward prices, and expected future values of underlying assets. The curriculum explains how replication strategies can create synthetic positions that reproduce derivative payoffs using combinations of underlying assets and borrowing or lending activities. Candidates also study cost of carry relationships, including financing costs, storage costs, and income generated by holding underlying assets. These pricing relationships form the theoretical foundation for derivative valuation models. Understanding arbitrage and replication helps investment professionals identify mispricing opportunities and evaluate the fair value of derivative contracts in increasingly sophisticated financial markets and trading environments. The curriculum also examines the pricing and valuation of forward contracts, futures contracts, and swap agreements throughout their life cycles. Candidates study how forward contract values change after initiation as market prices fluctuate relative to contracted delivery prices. The curriculum compares forward and futures pricing and explains why differences may arise because of daily settlement procedures and interest rate effects. Candidates also learn how swap contracts resemble a series of forward agreements while differing in valuation and payment structures. Interest rate swaps and other swap arrangements are analyzed to understand their role in managing borrowing costs and interest rate exposure. These valuation techniques are essential for assessing derivative positions, measuring risk exposures, and supporting effective hedging and trading strategies in financial markets. Options valuation is another important area within the derivatives curriculum because options provide asymmetric payoff structures and strategic flexibility for investors. Candidates study exercise value, moneyness, and time value concepts to understand how options derive value from underlying asset behavior. The curriculum explains the factors affecting option prices, including underlying asset prices, strike prices, volatility, time to expiration, interest rates, and dividends. Candidates also learn put-call parity relationships for European options and the role of arbitrage in maintaining pricing consistency. These concepts help investment professionals evaluate option strategies, estimate fair values, and understand market expectations regarding future volatility and price movements. Option valuation techniques support portfolio hedging, speculative trading, and structured investment product analysis across financial markets. The final section of the derivatives curriculum introduces the one-period binomial model and the concept of risk neutrality in derivative pricing. Candidates learn how binomial trees estimate derivative values by modeling potential future price movements and constructing risk-neutral probabilities. The curriculum demonstrates how derivative values can be replicated using combinations of underlying assets and risk-free borrowing or lending positions. Understanding risk-neutral valuation is essential because it forms the foundation for more advanced derivative pricing models used in modern finance. Overall, derivatives equips candidates with analytical tools for pricing, valuing, and managing complex financial contracts. Mastery of derivative concepts strengthens the ability to manage financial risk, enhance portfolio efficiency, and evaluate sophisticated investment strategies within increasingly dynamic global financial markets.